Good evening, class, and welcome to our advanced taxation class for this evening. The topic under consideration is transfer pricing. When we hear transfer pricing, we can learn about that in both advanced taxation and in performance management. And so I want you to activate some of the things that you have learned in performance management for this topic and bring it down here. We will not be doing the kind of calculation that we did in performance management here in transfer pricing, but it will broaden our knowledge of that. Now, we are going to be seeing the legal framework for transfer pricing. We'll see what is called arm's length principle. We'll look at the transfer pricing and multinational companies. Then we'll talk about things like transfer pricing methods that the OECD are also using to check transfer pricing issues. We will not be talking too much here. We'll be talking only relevant points that may have a strong impact on your examination. This topic is purely discussing. Now, let's go straight to the very thing that we want to talk about. What is transfer price? Transfer price is the price charged for goods or services supplied by one subunit to another subunit in the same group. This is not different from the definition you had in performance management, where people in a group are selling to another member of the group. Now, I use the word sell. This is because the seller or the vendor will have to make profits for that transaction, and the buyer will have to buy, or the buyer has a choice either to buy from a member of the group or to go outside to buy. But the technical word for transactions of this type between people of related parties, people of the same group, is called transfer. This is because, let's give an example now. If a wife has a shop that she sells maybe provisions, and the husband sends the child to go to the shop to buy provisions for the family. And, you know, being a family business, they patronize the family, and they bought provisions and brought home. Now, you will say, yes, they've paid for the provisions, but did that money increase the income of the family? No. It was just transferred from the husband to the wife. It's still in the group, in the family. And so sales is not a technical word because no real income has come in. No outside money has entered. So that's it. When we make that kind of transaction, it is called transfer. It is also referred to as the price at which an enterprise transfers physical goods and intangible properties. Intangible properties could be intellectual properties or franchise, or provide services to associated enterprise. Say, for example, associated enterprise, an example could be, let's say, FCA and Go Getter. The fact that one person is a director of those two companies shows them to be associated or related parties or associated enterprises. Now, when we talk about transfer pricing, we are talking with particular reference to multinational companies. So we are not dealing with local players. When we discuss transfer pricing in performance management, it was safe to use local players to understand the concept of transfer pricing, but it goes beyond that. And for taxation, it goes beyond local players. Transfer pricing with respect to multinational companies is a mechanism used by these multinationals to transfer goods and services between their related or associated companies worldwide. And this transfer price is determined either by external market price for a similar product, or it could be determined by a cost incurred basis. So it could be that the market forces will make you to sell at a price that is obtainable in the market. Or it could be that you are trying to make the product at a cost and get only a small markup or margin so that you can sell the product. So the rules for transfer pricing implementation in Nigeria is governed by the Income Tax Transfer Pricing Regulations 2018, which replaced the Income Tax Transfer Pricing Regulations of 2012. Now, from the transfer pricing law, it refers to prices at which goods and services are transferred between connected or connectable taxable persons. It could be tangible goods, such as raw materials, spare parts, finished goods. You know, something could be a finished goods for one group, and it could be a raw material for the other. Let's say, for example, cement is a finished product when it is packaged, and the cement company is selling it as a finished goods. The person who is a builder, it is a raw material, okay? Services could be management, marketing, accounting, insurance, even lecturing services. Intangibles could be trademark, patents, copyrights. So these are the things that could be transferred. All right, so the Economic Cooperation and Development, OECD, has prepared some guidelines on transfer pricing. And we are going to be looking at some of those guidelines that the OECD has put in place and people have adopted. We are going to look at a few, but not everything. But let me take you straight to some of the things that will be of interest in your examination. Let's go up a little. All right. Let's look at this advice on transfer pricing based on United Nations guidelines. The United Nations Model Tax Convention Article 1 states that where an enterprise of a contracting state participates directly or indirectly in the management or capital of an enterprising of the other contracting states, or the same person participate directly or indirectly in the management, control, or capital of an enterprising of a contracting state, and an enterprising of the other contracting states. And in either case, conditions are made or imposed between the two enterprises in their commercial or financial relations, which differ from those which would have been made between independent entities, then any profits which would have been accrued to one of the enterprises, but by these conditions have not been so accrued, may be included in the profits of that enterprises and taxed accordingly. Now, in other words, they are saying that the transactions between two related parties must be based on arm's length principle. We are going to talk about that in a moment. So let's go straight to some of those things and avoid some of these technical legal jargons. Okay. Now, the significance of transfer pricing. We said here that multinationals are the focal point here. And so transfer pricing is the instrument which multinationals use to transfer services, goods from their member countries or companies, different parts of the world. Now, it has an impact on the profits and taxes of the different jurisdictions in which these multinationals operate. And so transfer pricing could be a mechanism that, if adopted and used in a certain way, it could boost the head office profits, and it could also be a disadvantage to some companies. Now, imagine if Nigeria is part of the disadvantaged countries. You see that transfer pricing will have a kind of negative significance on Nigeria. So we are going to be discussing some of these things here. Go straight to that part. Is it still blank? Just a moment. Is everything blank? Okay, let me refresh. All right, so what are the objectives of transfer pricing regulations? The objective of the regulations put in place to examine transfer pricing is to ensure that Nigeria is able to tax on an appropriate taxable basis corresponding to the economic activities deployed by taxable persons in Nigeria, including their transactions and dealings with related persons. So it means that Nigeria should be able to tax appropriately. It means that Nigeria should not be so disadvantaged because of being in a disadvantaged tax jurisdiction. So the purpose of the objective of the OECD regulations on transfer pricing is to ensure that Nigeria should tax appropriately those multinationals and their dealings with related parties in Nigeria. It will also provide the Nigerian authorities with the tools to fight tax evasion through over or underpricing of controlled transactions between related persons. Now, I will explain this. What is tax evasion? Tax evasion, we said in the previous class, is when you are illegally trying to avoid tax. And you do that now by something we mentioned in the last class, that you report your income and you overstate your expenditures. But now you are seeing another thing here. You underprice controlled transactions. Okay, what are controlled transactions? Controlled transactions are those transactions that the group can control. It is not controlled by the market forces. You can control. For example, you can control the interest rate in which you charge your management services. You can say your management fees or management services could be any amount, any percentage, and it may not be in tangent with what the market is saying. So those things that you have strong control over, those transactions are called control transactions. Normally in the open market, it is the market forces that control the transactions. No government, maybe not even the US, could control some of the forces in the market forces. Sometimes they can play a major role, but they may not be able to control the market. So those ones are called uncontrolled transactions. But controlled transactions, especially with related persons, then each time you see related parties doing business, it is sometimes termed as controlled transactions. And so Nigerian authorities can fight tax evasion through underpricing or overpricing. So how can overpricing and underpricing lead to tax evasion? Let's say, for example, you are charging a management fee at a rate of 50%. 50%. And perhaps in the labor market, it is maybe 20%. So it means that you have overpriced. And because you are the head office, they are the group, they have no choice than to comply. And because they are subsidiary, you are the parent, they have no choice than to play along. And now, if the parent is in another country where the tax is very, very, very friendly, and Nigeria here is, though we are trying to clean up our tax system, but it is very unfriendly sometimes, you find out that that management fee that you are paying is an allowable deduction. And if it's an allowable deduction, it means it is to reduce your tax, your assessable profit, and in turn, reduce your taxable profit and your tax. So imagine, instead of paying 20%, you pay 50%. That means a large chunk of money has been allowed. And so these are controlled transactions. And when it gets to that other country, you find out that they may not be having high tax rates. And so even when the money comes high like that, they are paying very little tax. And you have also escaped Nigerian tax. And so this is another way of evasion. We also call this base erosion. Base erosion and profit shifting. I think that will be the next topic after this because they have some similarities. Now, it also reduces the risk of economic double taxation. Economic double taxation. It also provide a level playing field for both multinational enterprises and independent enterprises carrying on business in Nigeria. So independent enterprises could also be local players. Multinationals could be global players. So they provide a level playing field. So whatever advantage the multinationals is getting, the independent enterprise will get and all that. Then it provides taxable persons with certainty of transfer pricing treatment in Nigeria. It means that if you are doing anything that requires transfer pricing, you are doing it with certainty. You know what obtains. You know how it is handled. It is not an uncertain business. All right. What is the scope? Now, the regulations shall apply to transactions between connected taxable persons carried out in a manner not consistent with arm's length principles. And so when we say arm's length principle, what do we mean? Arm's length principle is the way you deal with somebody you don't know. If a person you don't know from Adam comes to your shop and want to buy something, how much will you give the person? You have a particular profit markup or cost markup or profit margin you want to make. And if somebody who you don't know from anywhere comes, you want to make that margin or more. That means you are dealing with at arm's length. You're not bringing him close. But when you are bringing somebody who is close and you now start hearing things like, now because of you, when you hear, now because of you, or if not because of our closeness, then you are going away from arm's length. So now you see now, when you are dealing with related party, that relationship makes it look like, oh, it is because of our relationship, oh, if not that we are in the same group. So those kind of things, you have now carried out a business in a manner that is not consistent with arm's length. And so these regulations apply to those transactions that are not conducted with arm's length principles. And it includes sales and purchase of goods and services. I just mentioned sales of goods, purchase of lease or lease of tangible assets. Then there's intangible assets, provision of services, especially management services, lending or borrowing of money. It could be in the form of share capital or capital structure. Instead of paying or buying shares, you are buying preference shares, debentures. You are kind of borrowing money and you are going to be paid interest. And you see now, there is a way that these things can be done and you won't follow arm's length principles. Manufacturing arrangements and any transaction which may affect profit or loss or any other matter incidental to, connected with, or pertaining to transactions referred to in the regulations. Now let's look at arm's length principle. This is a subheading that deals with that. Now, every taxpayer is expected to comply with arm's length principles in dealing with transactions between related enterprises or entities. Now, the enterprise and multinationals are expected to be guided with the following principles. Now, look at the principles here. Where a connected person has entered into a transaction or series of transactions to which these regulations apply, The person shall ensure that the taxable profit resulting from the transaction or transactions are ascertained in a manner that is consistent with the arm's length principle. So it means if you are dealing with your relative, if you are dealing with your business partner, your spouse, your any form of close relationship, you have to ensure that the profit you're going to make from them is still the same kind of profit that you make from somebody who is not related to you. A controlled transaction is at arm's length if the conditions of the transaction do not differ from the conditions that would have been applied between independent persons in comparable transactions carried out under comparable circumstances. So it means that if people in a group are doing business and you now ask, how much do you charge? The price I'm going to quote for you, who is a related party, would not be different if I just call an independent person and call and say, oh, in the same circumstances, how much are you going to charge me? It should be able to charge you something similar. And so that shows this is arm's length principle followed. But if it charges you something higher or something lower, then this is not arm's length principle that you are following. Where a connected person fails to comply with the provisions of this regulation, the service shall make adjustments where necessary to bring the taxable profit resulting from the transactions in conformity with the arm's length principle. Now, a typical example is when you decide to sell a chargeable asset, of which there's going to be a capital gains tax to be charged on it. You're supposed to sell that asset for 10 million naira in the open market. Okay, that is what the asset is worth. Then you decide to sell it to your uncle for the rate of 6 million naira. It means that your chargeable gain, let's say you bought it for 5 million and you sold it for 6 million, chargeable gain is 1 million. Meanwhile, if you have done it in the open market, you would have gained 5 million more. And your capital gains tax is supposed to be 500, you are giving it at 100. So what here is saying is that since you fail to comply with the arm's length principle, the revenue service will make adjustments, meaning that they will consider that transaction with the connected person in a closed, in a closed transaction, controlled transaction. They will consider it as though it was done in the open market. They will assume that you have charged the same way that the market is charging. And so whether you are collecting 600,000, it will be deemed as if you collected 1 million, and you'll be paying the appropriate chargeable tax. So that is what this is saying. Now, transfer pricing companies. I've said this in the intro. Multinational corporations, which are also multinational companies, are corporate organizations that own or control production of goods or services in more than one countries other than their home country. And so they have a centralized head where they coordinate or do their management. Companies like ExxonMobil, Total, Chevron, Egypt, Shell now dominate the oil sector as multinationals. Then we have other companies like Cadbury, Guinness, PZ, Nestle. Some of them have left. Some of them are still here. MTN is there, Nine Mobile, Airtel are multinationals in the telecommunications sector. And so refresh this now. All right. In a multinational group, a member of the group in one country may supply goods or service to another member in another country. So that is a transfer. And the price is charged when they are making these things becomes revenue for the person selling, and it's a cost of purchase for the person that is buying. Now, when companies operating under different tax jurisdiction belong to a group, they may decide on what they want to achieve. They may want to underprice or overprice intergroup transactions. And in that way, they are doing something called tax avoidance. So the multinationals could say, if you are in Nigeria, those people in Nigeria, we may want to overprice them. Then there are some people who are in certain countries, they may want to underprice them, depending on what they want to achieve. Okay. Then we have custom duties and tariff manipulations. Custom duties paid on imports and exports are usually based on transfer prices. So it means that if you are paying for imports into Nigeria, you don't want to pay high import duty. It's charge or anything coming to Nigeria. When it is underpriced and it gets to the ports, they will charge it on how much that is being priced or transfer price. So if there's something that's supposed to cost 1 million and you are charging it at 700,000, the custom and tariff duties will be charged on what is on the invoice. And so this leads to something called tariff manipulation. So you have manipulated the tariff in Nigeria to ensure that they charge very low tariff in Nigeria by underpricing Nigeria imports. Then sometimes too, it also happens with exports too. You may want to overcharge. So when you overcharge Nigerian imports when you manipulate Nigerian imports so that you have high import rates, you may also want to use that too as a tool, because those things too has their own place. Then we have dividend manipulation. Now listen to this. An instance of dividends manipulation is when a country A, restricts an amount that can be paid to country B. So country A is restricting the amount. Say you cannot pay more than 1 million, say $1 million to country B. The company in country B may decide to overprice their goods and services, which they are selling to A. The implication of this is that more funds will be remittable to the other country in B without violating any restriction on dividends. So you have restricted the amount that you want to pay as dividends in B. And so B may overprice their goods so that that overpricing of their goods is done in such a way that you have not violated any dividend law, and so you are still going to get paid. It's just like saying that, okay, you want to recover the money, you want to recover some money by maybe if you tell someone that you buy an item, let's say you bought the item for 50,000 naira, and the person will not even give you your transportation and other logistic you spent, and you want to recover those items. You now tell the person that, I bought this thing for 80,000 naira. You have overpriced it, and you are doing it because you want to recover some other expenses that you made that the person may not want to. So that's similar things here. Then imposition of excess charges. The parent company can also impose excessive charges on its foreign subsidiaries in respect of provision of intangibles such as patents, licenses, trademark, and use these avenues to extract profits to a tax haven. So it means that where the head office is in a tax haven and it's enjoying favorable tax regime, where the higher the income you make, the lower the tax you pay, they might decide that, okay, they will set the head office there and they will be providing trademark to all subsidiaries. And Nigeria is a subsidiary, and they charge excessive percentage on their trademark, which you must pay for you to operate. So now that amount that you are paying is a very high amount, and it's leaving Nigeria. Mind you, it is part of your cost of sales. It is going to reduce your profits. And when it reduces your profits, Nigeria would have lost huge tax figures. And now it is escaping to, let's say, the UK. No, the UK is not a tax haven. Let's say it's going to Switzerland. And you see now, the higher the income you make, the lower the taxes you pay. And so they have achieved something here. They're enjoying favorable tax requirements, and it is bringing a problem to Nigeria. It is the practice of tax authorities in Nigeria to ensure that transactions between connected persons or related persons are not made at arm's length to reduce tax liabilities. Transfer pricing methods and taxpayers controlled transactions. So we're going to be looking at the crux of the matter. These are transfer pricing methods that is in place. So according to Section 5, subsection 1 of the Act, the following transfer pricing methods can be applied to determine whether the result of a transaction or series of transactions are consistent with arm's length principles. So these are methods in which they check transfer pricing transactions to see if arm's length principles are being followed. The first one is called the COP method. It is called comparable uncontrolled price. We'll talk about it. Then we have the resale price method. Then the cost plus method, the transactional net margin method, and the transactional profit split method. Now let's talk about each of them. The first one is the COP method. I'm trying to get this thing to All right, so let me refresh. Okay, so let's get to the COP method. All right, here is it. Now, what is the COP method? The comparable, uncontrolled price method. So now you see comparable. So that means there may be something that should be compared. Then there's called uncontrolled price. So this is uncontrolled, is something that is not controlled. We mentioned before controlled transactions. Now, this is uncontrolled. Now let's look at it. COP M compares the prices charged for transactions between associated parties, also called related parties, with the prices charged for similar transactions between independent, unrelated parties in comparable circumstances. Now, normally, you see associated companies will want to have controlled transaction. So when you deal with associated party and it is seen as controlled transaction, in that same set of circumstance, if two independent, unrelated parties hold similar transactions, will they have similar results? Will they be given the same prices? Now, any difference between the two prices is an indication that the transactions between the associated enterprises are not made at arm's length. Now, the reason is that it is assumed that unrelated parties will want to follow arm's length. Nobody will want to do that because of you. If you know who buy, please they go. Now let's look at an example. Ben Limited and Bella Limited are members of the same group. Now, Ben Limited sells a particular product to other independent parties. Let's say they are selling spare parts. Let's say this is a motor tire. They are selling it to independent buyers that they don't know. And they're also selling it to Bella Limited under the same circumstances. So now, the price that Ben Limited will charge to Bella should be the same to how they charge independent parties, because they're buying it under similar situations. So this is what they call internal comparability. This is because you are comparing Ben's sales to Bella with Ben's sales to outsiders. Now, if an independent party, let's say M Limited, sells to another independent party, N Limited, the same product, they don't know each other, and they sell these things to one another. If it is the same product that X Limited sells or buys from M Limited, then this can be used as external comparability. External comparability, whereby they are not related. Non-related parties are doing business here, they are not related. And so, if there is differences, the tax authority may reject the prices between X Limited and Y Limited, which are associated parties, and they will adopt what M and N are doing. This is because M and N are not related, and they're not buying anything from X and Y. But X and Y are dealing with each other. They are related party. M and N do not know each other. They are dealing with each other independently. That is external comparability. So they are comparing external people who do not know each other with your company group affairs. This is different from the group affairs is compared with one of the group selling to an outsider. That's internal. But two outsiders selling to each other compared with the group doing business with each other. That's external. And so they may reject the group's prices and adopt what the external people are doing. So that's what they called comparable uncontrolled price. So the prices should not be controlled. If two people, independent parties, are doing business, they are doing it in the open market, which is uncontrolled price. And now, comparable situation between connected persons with independent persons. If the prices are not controlled, then it's fine, arm's length. But if the connected persons are having a kind of controlled pricing, then it means they can restrict, they can manipulate, because they control the prices is under their control. So you see the COP method here. We have the resale method, the resale price method, RPM. Now, retail price method starts with determining the resale price to an independent enterprise from something that you purchase from an associated company. Let me give myself an example. I bought something from FCA, that is a related party, and I'm now selling it to another enterprise that is not related or not in the group. Now, our resale method will start with how much am I selling to this independent person, and what is the appropriate gross margin that I should make. Let's see an example. God's Will Limited and Tent Limited are related companies. Now, God's Will Limited transfer goods to Tent Limited. That's related party transaction, and it's likely to be controlled transaction. And now Tent Limited sells these transfer goods to unrelated parties. Under the resale price method, the price that Tent Limited sell to independent people, normally in an arm's length price. So they will sell them at arm's length price normally, because they will want to say they are selling at arm's length price. But now they acquired it using a non-arm's length price. So that's non-arm's length transaction is determined by reducing the price realized on this resale of the products. So what it means is that you have an appropriate gross margin. So if you are selling, what it means is that if you sell something, let's say something that is normally being sold at 1 million naira in the market. You now sold it at 1 million. That's fine. Arm's length is being recorded here for you. And it is determined that in the market that you are supposed to make a 20% profit margin, which means that 200,000 naira would have been your profit, right? That means that you should have bought it at 800,000 naira. That's what the implication means. But what happened? Because you did it at non-arm's length purchase, you bought it cheaper. You perhaps bought it 600 or 500,000. And so you see, you acquire something non-arm's length and you are selling it at arm's length. And so your gross profit margin, it says here that it will reduce the price realized on the resale of the product by an appropriate gross margin. And so what is happening here is that they will assume also that you have bought this thing at 800,000, even though you bought it at 600,000. Or they will reduce your margin in such a way that you bought it at 500,000. You're not supposed to sell it at 1,000 naira. So whichever way, the resale pricing, the resale price method starts with your resale price. How much did you sell what you bought? You sold it at arm's length. You didn't buy it at arm's length. And so they will use the retail price method to determine what the arm's length purchase would have been. Then the cost plus method. What is the cost plus method? Cost plus means cost plus a markup. Now, markup is different from margin. What is the difference? In performance management, we are told that markup, the cost is 100%. Then you have a markup. Markup is any percentage on your cost is a markup. Now note here that for markup, the cost is 100%. And so when you do a markup, something you bought for 100,000, and you do a markup of 10%, it means that your selling price will be cost of 100,000 plus your markup of 10,000, which is 110. This is different from margin. In margin, sales is 100%. So it means that if you bought something for 100,000 and you are told that your margin is 10%, it means that your profit is 10%. You simply remove 10% from your sales, you determine your cost, which is 90,000. So you see, markup and margin are not the same. So even though in this example, both of them have 100,000 naira as the sales. But you see here, if 100,000 is the sales, that means 10,000 naira was your markup. It means that your cost is 90,000. You have a 10% markup. But if 100,000 is your sales and your margin is 10%, your cost is still 90%. But the thing is that markup margin and markup and margin, they are percentage. If you are given the same percentage of markup and same percentage of margin, both of them will not give you the same value. Now look at cost plus method. You have a cost and it starts with the determination of the cost incurred by the supplier. So they will determine the cost that you have incurred, and the tax authority will add an appropriate markup so that you are not underpricing or overpricing. For example, D Limited and G Limited are related companies. D transferred 110,000 units of its product to G at 700 naira per unit. That means the direct cost incurred by D to produce the same product is 400,000 per unit. Now, the arm's length markup earned by companies producing and selling similar products to independent companies or parties is 45%. So the tax authority will recognize these limited to G sales as 100,000 units. And look at it here now. Your cost is 400,000. 400,000. Now you want to have a markup. Multiply it by 145% or 1.45. That will give you 5,600,000 instead of 7 million. So your markup should not be 7 million. So instead of 7 million, which you now use 700,000, 700 naira to sell the 110,000 units. So you see here now that you are expected to have a markup of 5-6 million instead of 7 million. And so that way, they have determined that your sales is not at arm's length. And so they know how they can adjust your regulations, your books, so that those ones that are not arm's length, you will be taxed appropriately. Then we have profit split method. Profit split method starts with determination of the combined profits that arise from a business transaction in which the associated enterprises are engaged. Then the profit is then shared to these enterprises in a way that reflects the division of profit that will be expected among independent enterprises. So profit split method. Okay, so let's say you decide to do a combined business, just one business, and you made a profit. Now, the profit is going to be split. The profit is going to be split on an appropriate base. Let's say it is a custom to share the profits based on your capital supplied. So your profit will be based on capital supply. So the profit split method, we then check how much did you contribute? What is your profit or your markup? Let's say markup, what is the profit that you are supposed to make? So they are going to look at the appropriate basis for you to make that particular amount of profit, and they will not judge from that if it is at arm's length or not. Transactional method. It begins with the determination of net profits from an associated parties transaction and compared with profit margin and in comparable transaction with independent enterprises. So it's the same thing, almost the same thing with the profit split off. So, but the profit split off now it's almost similar So this transactional net margin, it will now look at what did you contribute, what risk did you take, what contribution did you make apart from monetary contribution. So all of these things help in the determination of what will be given to you as profits. Let me refresh. Intergroup services. We've talked about this for some time, so let's leave that. Now, intangibles. The determination of arm's length condition for controlled transaction involving exploitation of an intangible shall take into account the contractual agreement and the following factors with regard to development, enhancement, maintenance, protection, and exploitation. So now, here, you'll be looking at the functions performed by a person, each person, management and control of this function. What contribution did you make? And what risk did you assume? Let's say, for example, you are building a plane. It's a project. A plane is not something you just build overnight. So, different countries, different national, different experts come and they are working on it. What are the functions performed by each of these professionals to be considered? Then what are the management and control of this function? What risk did each country assume? Some people may not take much risk, but they provide contribution, much capital, but risk, they take less risk. Another person may take high risk, but his capital is inadequate. All of these things will be considered. So we've really talked about the major thing here that will come out in the exam, if ever this is going to come out in your exam. The transfer pricing method, which is the COP method, the profit split, then the other one here is transactional net profit, resale price, what have you. These are where you should look at in discussing in ICAP. Now, transfer pricing policy. A transfer pricing policy is a document that guides the conduct of related parties transaction within a group of companies. And there are two types: group transfer pricing policy, local transfer pricing policy. And some of the features here, it's typically prospective in nature. So it's not talking about the past, it's talking about the future. Typically not updated until there is a significant changes in the business, and provide a future view of likely companies that might come to become intercompany transactions. And the guidance provide guidance on pricing of transactions and methodology. And of course, these days you are expected to have a compliance report, which is submitted to FIRS. Okay. So some of the things that will be disclosed in the transfer prices submitted to FIRS is the particulars of the reporting company, income from control transactions. When I say control transactions, these are transactions of, say, group of companies. These are transactions that related party. So you need to provide um, particulars of the reporting company. What are their names? What kind of currency did they use? What are their style and all that? Income from control transactions. So the income you get from those control transactions, you have to report them. Cost of control transaction. How much did you spend in control transaction? Then summary of transactions with connected persons. And so you can also do that with non-connected persons. So some of these things here are just for comprehensive material, but many of them are not coming in your exams. So the things I will advise you to focus on is the objective of transfer pricing. You need to know the transfer pricing method. You need to know the arm's length principles. These are the places where I will see them bringing exams for you. So far, so good. We've come to the end of this topic. And one of the things that I want to stand out here is that transfer pricing is dealing with multinationals, different countries, different tax jurisdiction. And there are ways in which they will use transfer pricing as a tool to manipulate dividends, manipulate tax, uh, manipulate custom duties, and all that. So it's also a manipulation tool by these multinationals. That's why the OECD has provided tax guiding regulations to help curb some of these things. Then you need to know the method. I've mentioned it briefly, and you need to know the arm's length principles. So do you have any question that you want to ask me? Feel free to ask now. The next 1 minute, if I didn't see a question, that will be all for today. All right. So there's no question now. That will be all for tonight. In our next class, we will be looking at base erosion and profit shifting. Now, this is also having a connection with this topic so that by the time you learn them together, everything will have a harmonious relationship. Because they have a harmonious relationship with each other. The topic, when you learn this other one after this, you get to understand some of these multinationals and their doings as it relates to tax. So thank you so much for coming to class, and we'll see you again in our next class. Do have a wonderful day. Bye for now.